This podcast includes content created and/or enhanced using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast.
Imagine closing a book. You want that feeling of finality, that all the storylines are neatly tied up right. Well, for companies, that final chapter is liquidation. And in places like Luxembourg, it's far more intricate, more strategic than just simply closing shop. As of today, August 4th, 2025, we're doing a deep dive into the fascinating and precise world of corporate finality here in Luxembourg. Specifically, we're looking at the art and science of company liquidation, focusing on solvent société anonyme, it's an SA, like a public limited company, and société à responsabilité limitée, the SARL, which is more like a private limited company, and also the société en commandite par action, or SCA, the partnership limited by shares. Our mission today really is to cut through the complexity. We want to give you a clear, insightful understanding of this voluntary winding up process. We'll explore the surprisingly distinct pathways to closure, pinpoint a key legal distinction that can save you quite a headache, actually, and explain why one professional's role is absolutely paramount in ensuring a smooth, definitive exit. So let's get into it. Why does the end of a company's life in Luxembourg demand such rigor? What's really at stake?
Well, what's truly compelling here is that the bedrock, the foundation for voluntary liquidation of solvent companies in Luxembourg, isn't some new law. It's the Loi du temps, ou 1915 concernant les sociétés commerciales. We just call it the 1915 law.
1915, that sounds quite old.
It is. But, for a premier financial center built on stability, its age is actually its greatest strength. It means over a century of established precedent. This law, it's been consistently interpreted, refined by decades of case law. So its procedures are crystal clear, and the outcomes, they're highly predictable.
Predictability. That's key for investors, isn't it?
Absolutely. For international investors, this isn't just a nice to have. It's a really high value asset. It means you're stepping into, a perfectly lit room, not some kind of legal labyrinth. It significantly reduces legal risk, both for entry and, critically, for a clean, orderly exit.
Right. And that emphasis on predictability means precision in language is absolutely vital, especially with terms that often get mixed up.
You're spot on. To navigate this properly, we need to be really clear on three distinct concepts. First, there's dissolution. Think of this as the formal legal decision to stop the company's normal business. It's usually a shareholder resolution, typically formalized before a notary. From that moment, the company's purpose narrows right down. It just exists to wrap things up. And all its documents have to state in liquidation.
Okay, so dissolution is the decision. What's next?
Second is liquidation itself. This is the process, the practical work that follows dissolution. An appointed liquidator steps in, sells the assets, collects debts, pays off all the creditors, and then hopefully distributes any surplus back to the shareholders.
Got it. Decision, then process, and the final piece.
And finally, strike off. Locally, it's known as radiation. This is the last administrative step. Once the whole liquidation process is done, the closure gets filed with the Luxembourg Trade and companies register the RCS. The RCS then formally removes the company from the register. Its legal existence ends. Although, as you hinted, there's this interesting passive survival bit we need to talk about later.
What's also quite, neat about this structure is the clear handoff of liability, isn't it? Director step back, liquidator steps in.
Exactly. That legal separation is fundamental. It ensures clear accountability right through the winding up. Everyone knows where the buck stops, so to speak.
Okay, so if a company is solvent and wants to wind down voluntarily, what are the practical choices here in Luxembourg? What are the routes?
Well, basically, there are two main pathways under that 1915 law. First is what we usually call the standard three-step liquidation. This is very formal, very methodical, robust. It's really suitable for all companies, but especially those with multiple shareholders, because it gives maximum oversight and protection for everyone.
Okay, the standard route. And the second?
The second is the simplified one-step dissolution. Now, this is highly streamlined, much faster, but, and this is key, it's exclusively for companies with just a single shareholder. Here, essentially, all assets and liabilities just transfer straight to that one owner.
Right. And we should be clear what these voluntary options are not. We're not talking about companies forced into closure by a court, are we?
Absolutely not. That's a crucial distinction to make. We are definitely not discussing judicial liquidation that's court-ordered, usually because of insolvency or maybe big shareholder fights. And we're also not covering the newer administrative dissolution procedure that came in early 2023. That's a tool the state, the public prosecutor, uses to get rid of non-compliant, empty shell companies. No assets, no employees, breaking the rules.
Okay.
Our focus today is purely on the voluntary winding up of a company that is still solvent and choosing its own exit.
Right. So let's unpack that first option, the most common one, the standard voluntary liquidation. Walk us through those 3 steps.
Sure. The journey starts with step 1, the dissolution and appointment of the liquidator. This takes place at an extraordinary general meeting, an EGM, of the shareholders, and it must be held before a Luxembourg notary. That's mandatory.
The notary.
At this EGM, shareholders pass 2 key resolutions. First, formally dissolve the company. Second, appoint 1 or more liquidators. Could be an individual, could be a corporate entity. The notarial deed then captures all this resolution, who the liquidator is, their powers, usually very broad, and often their pay. As soon as that deed is filed with the RCS, the company's status changes to end liquidation. The liquidator takes full control from the old directors. It's a very clean break.
Okay. Liquidator appointed, control transferred. Then the real work begins in step 2.
That's right. Step 2 is all about the liquidation operations and the audit. This is where the liquidator rolls up their sleeves, they sell the assets, chase up any debts owed to the company, and crucially pay all the company's creditors. That includes tax, Social Security, everyone. And interestingly, if all the debts are paid off, or at least there's enough money set aside for them, it's actually possible to make advance distributions to shareholders even during this phase. Once that's done, the liquidator prepares a detailed report and the final accounts for the shareholders. Then they call a second EGM. Now, this one doesn't need a notary. It can be done under private seal.
Ah, okay. Less formal.
Yes. At this meeting, the shareholders look at the liquidator's report, and importantly, they appoint a liquidation auditor, a commissaire à la liquidation. This auditor is a really vital independent check. They review everything the liquidator has done.
So the auditor checks the homework, basically. And then we get to the final step, step 3, the closure. How does that wrap it all up?
Exactly. For step 3, the closure of liquidation, the auditor provides their report to the shareholders. Assuming it all checks out, the liquidator calls the third and final EGM again. No notary needed. This meeting is where you get real finality. Shareholders approve both reports, the liquidators and the auditors. Then they grant a full discharge, it's called a quitus, to both the liquidator and the auditor.
The quitus? That sounds important.
It's paramount for them. It releases them from liability based on everything they've disclosed. It's their protection. Shareholders also approve the final distribution of any leftover assets, the boni de liquidation. And they decide where the company's records will be kept for the legally required 5 years. Finally, a formal resolution is passed declaring the liquidation officially closed.
And then it's off to the register.
Yep. After that EGM, the decision is filed with the RCS for publication, and the company gets formally struck off the register. But now, here's that concept we mentioned, 5-year passive survival.
Right. Tell me more about that.
Even after being struck off, the company is legally considered to kind of linger for 5 years. This is purely for the benefit of any unknown or contingent creditors who might pop up later.
Like what kind of creditors?
Oh, think potential tax reassessments down the line, or maybe long-term contractual warranties that suddenly get claimed. It means the liquidator has to be incredibly careful, exceptionally diligent in identifying and putting money aside for all potential future liabilities before making that final distribution. Because if they miss something, that quitus, that discharge they got, could potentially be challenged later on.
Wow, that's fascinating. It really underlines the need for thoroughness, even after things seem finished.
Mm-hmm.
Okay, let's switch gears now to the other option. That swift, single-step path, the simplified dissolution. What makes it so efficient, and who exactly can use it?
This really is a standout feature for efficiency in the Luxembourg system. It's governed by Article 1101 of the 1915 law, and it's exclusively for companies with just one single shareholder. That's the absolute condition.
Only one shareholder. Got it.
Its speed comes from something called dissolution confusion. It sounds a bit odd, but basically, the company dissolves. And poof, all its assets and liabilities are automatically transferred by law directly to that sole shareholder. There's no formal liquidation period, no liquidator gets appointed. It's incredibly fast.
Okay, super fast. But what's the catch? What's the trade-off for all that speed? Sounds almost too easy.
Well, there's a very significant one. The sole shareholder, in return for that speed, assumes unlimited personal liability for all the company's debts, even debts they didn't know about when the company dissolved.
Unlimited personal liability. Okay, that's a big one.
It is, which makes this simplified route perfect for very clean, straightforward, non-operating holding structures. Maybe a dormant company with no complex history. But it's generally seen as too risky for operating companies that might have hidden contracts, potential lawsuits, or other legacy issues lurking.
Right, makes sense. So to even get onto this fast track, there's a critical hurdle to clear first, isn't there? This certificate trinity.
Ah, yes, the certificate trinity. That is indeed the gateway. A notary won't even touch the dissolution deed unless the company provides 3 specific certificates proving it's in good standing with the state.
Yeah, what are they?
First, you need one from the Direct Tax Administration, the ACD. This confirms all corporate income tax and net wealth tax is paid up. There's actually a dedicated email for this, certificate.liquidationsimplify@code.etat.uu. Second, one from the VAT Authority, the AED, confirming all VAT obligations are settled. You have to tell them you're stopping activities first, though. And third, from the Social Security Center, the CSSF, confirming all Social Security contributions are paid. Usually done via the myguichet.lu online portal.
Okay, tax, VAT, Social Security.
Exactly. Each certificate is only valid for 3 months, so it creates a kind of practical window to get the dissolution done. And this whole process, it effectively acts as a powerful sort of state audit before you can close quickly. It ensures companies can't just use this fast exit to dodge their fiscal and social debts. It really maintains the integrity of the whole system.
So once you have those 3 golden tickets, what happens at the notary? And what about creditors? Are they protected?
Right. With the certificates in hand, the sole shareholder goes to the notary. The notarial deed of dissolution will state there's only one shareholder, reference those 3 certificates, formally dissolve the company, and enact that automatic universal transfer of assets and liabilities. It also usually grants discharge to the outgoing managers and says where the records will be kept for 5 years. Now, even though there's no liquidator, creditors do still have some protection. After the dissolution is publicly announced, creditors get a 30-day window. During that time, they can go to court and ask for safeguards if they think the transfer of assets to the shareholder puts their claims at risk.
Okay, let's get practical now. Timelines and costs. How long does all this typically take, and what should people budget for?
Right. Timelines, they can vary hugely. A standard liquidation, well, it could be anything from a few months if it's a really simple holding company, to potentially several years if it's a complex operating business with lots of assets to sell or complicated debts to sort out.
Years. Wow.
Yes, the complexity of assets and liabilities is the key driver. And if it does go beyond a year, the liquidator has to give shareholders an annual progress report. Now, compare that to the simplified dissolution. The timeline there is almost entirely down to how quickly you can get those 3 certificates. That could be several weeks, maybe a few months, depending on the authority's workload. But once you have them, the dissolution itself is instant when the notary signs.
Big difference in time. What about the costs? You mentioned an art to legal pricing earlier.
Yes. Well, the cost breaks down into fixed and variable parts. The fixed and official costs are things like notary fees. They aren't negotiable. They're set by a Grand Ducal regulation, calculated on a sliding scale based on the company's assets. And the RCS filing fees are also fixed administrative charges. For example, the final strike-off for an SA or SARL, it's currently around €105 plus some admin taxes.
Okay, fixed fees. What about the variable ones?
That's where the art comes in. The variable and negotiated costs. The biggest one is usually the liquidator's fee in a standard liquidation. There's no official price list. Their fee depends on how complex the job is, how much time it takes, and this is critical, the level of risk and liability they are taking on.
The risk factor.
Exactly. It can be a fixed fee, hourly rates, or some combination. I often think of it as like an insurance premium for finality. Their diligence is what protects everyone at the end. Legal counsel and auditor fees are also variable, negotiated based on the scope of work. So the real art isn't about haggling prices. It's about smart scope management, having really clear engagement terms, and liaising efficiently with everyone involved. That's how you manage the costs and the timeline.
Makes sense. Now, the 1915 law is the bedrock, but you mentioned Luxembourg's corporate landscape isn't standing still. What recent laws fit into this bigger picture?
That's a great point. Things are evolving. So as we touched on, since early 2023, we have this procedure for administrative dissolution without liquidation under a law from October 2022. Again, this isn't something a company chooses. It's a tool for the public prosecutor to clean up the register by removing defunct, empty shells, no assets, no people, breaking the rules.
Right, housekeeping by the state.
Exactly. Then, in late 2023, Luxembourg brought in a major overhaul of its insolvency law, the law of August 7th, 2023. This introduced really sophisticated tools like judicial reorganization, conciliators, to help companies that are in financial difficulty to try and restructure and avoid going bankrupt.
Okay, so that's for companies in trouble, not solvent ones exiting.
Precisely. That's the key distinction. The 2023 law is for pre-insolvency and insolvency situations. It does not change the procedures we've been discussing for the voluntary liquidation of a solvent company. That still sits firmly under the 1915 law.
Important clarification.
Yeah.
Anything else on the horizon?
Well, looking ahead, as of now, mid-2025, there's a major reform of Luxembourg's accounting law underway, Project of Law 8286. While it's not directly targeting liquidation, any significant changes to accounting standards or maybe the thresholds for company sizes or audit rules, well, those could potentially impact how liquidation accounts get prepared or the work involved for the auditor. So that's definitely something to keep an eye on as it progresses.
It's really interesting how these different pieces of legislation seem to connect, creating a more complete picture.
They absolutely do. When you look at them together, the insolvency reforms, the administrative cleanup, the established solvent liquidation paths, it shows Luxembourg's coherent strategy. They're aiming to enhance the entire corporate life cycle, from helping viable businesses restructure to cleaning the register to providing these clear, efficient exit routes for solvent companies. This whole holistic approach, it really strengthens the jurisdiction's attractiveness and its reputation for stability and good governance.
So, after this really comprehensive deep dive, what would you say are the key takeaways? Why does Luxembourg's liquidation framework stand out? What are its unique advantages?
I think it boils down to a few core strengths. First, as we said right at the start, predictability and legal certainty. That 1915 law, being so well established, offers incredible stability that's priceless for international players. Second, flexibility and efficiency. Having that dual-track system, the really robust standard process alongside the super fast simplified one, that's a major plus. It gives options tailored to the situation. Third, you've got a really sophisticated professional ecosystem. Luxembourg has this deep pool of world-class notaries, lawyers, auditors, fiduciaries who are genuine experts in these processes. That ensures high standards. Fourth, there's integrity and creditor protection. The framework does a good job balancing efficiency with making sure creditors are protected and that companies meet their tax and social security duties, especially with that certificate Trinity check. And finally, as we just discussed, this holistic lifecycle management. Recent laws show this commitment to a dynamic, resilient, and high-quality corporate environment right from setup to closure.
Okay, that's a great summary. So as we wrap up, let's quickly revisit the three most important insights for listeners to take away from our conversation today.
Sure, first takeaway. Really understand the two distinct paths. There's the traditional three-step liquidation offering robust protection, and then the efficient one-step simplified dissolution, but only for single shareholder companies. Knowing which path fits is the first crucial strategic decision.
Got it. Path 1 or path 2? What's number 2?
Second, remember, the governing law for voluntary solvent liquidation is the old, reliable 1915 law. Don't get it mixed up with the much newer 2023 insolvency law, which is for companies facing financial distress. Totally different scenario.
Okay, 1915 law for solvent exits. And the third key insight.
Third, the liquidator's role is absolutely central in the standard process. Their careful, diligent work and ultimately getting that final discharge, the quitus, from shareholders that is paramount for achieving a truly definitive and, importantly, liability-free corporate closure. Think of it as your insurance policy for finality.
Understanding the end of the corporate journey, it seems, is just as vital as planning its beginning. And the Luxembourg framework really does offer a masterclass in achieving that finality with certainty, efficiency, and integrity. And just to leave you something to think about, how does that concept of passive survival, that 5-year post-liquidation period where unknown creditors might still appear, how does that fundamentally change how we think about finality in corporate law? Does it mean you can never truly 100% say it's completely over? And how might that thought influence strategic planning right from day one when a company is first set up?
This podcast includes content created and/or enhanced using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.